Hi guys, Oleg Tkach here with your weekly rate update, and the market continues to be extremely volatile in a major churn of events last Friday when Silicon Valley Bank essentially had a run on the bank. And what that means is you have more people trying to withdraw more funds than the bank actually has available to give them. And it's because the bank's money is all tied up. And what caused that? Essentially, it was them investing money into different treasuries and bonds. That money was invested prior to the rates going up the way they went up. And basically, once different people that had money deposited with them, mainly the tech industry, found out that they're in trouble, everybody rushed to withdraw funds, and that is what caused the run on the bank. The fact is it exposed a bigger systematic issue with how many more banks are at risk with the Fed raising as high as they raised rates. How many more banks have the same exposure? Then you found out there's a bank in New York, there's other banks too. Now there's apparently 6 banks on the watch list. So because of all this, there's 2 parts to it. What is the Fed going to do? Knowing that raising rates and continuing to raise rates is even going to make this problem larger, which overall it's a big issue for us if people, if there becomes a more and more of a run on the bank with other banks, and what other exposure do we have out there that we don't even know about? Is the Fed going to continue going higher, knowing that it's going to even further deepen this issue, or is the Fed going to step back? And that's one part of it. The second part of it is the part that if they continue raising, are there certain banks that would be okay now, which then would lead them to be even exposed and to have issues? So all eyes are on the Fed, because if they don't raise, the question is, with the economy speeding up as much as it's sped up, are we going to see inflation spike again? Fed is clearly has a really tough decision ahead of it on this coming Wednesday. Now, most people are banking, when I say most people, investors are banking on a 0.25% rate hike, which is what Europe just did, and we really mimic Europe, and Europe mimics us in a lot of the things that we do. Now, there was a time where in the last few days where people were betting on a no rate hike in general. The 50 basis point rate hike that was really driving the rate market up is completely off the table now. We saw rates come back down from the highs that we saw basically a week ago, where we saw rates improve almost by 0.75%, where rates were in the high 6s to low 7s, which now we're in the low 6s again, which is great for everybody mortgage-wise. Now, what's going to happen next? Well, we could really go into a very volatile, even in an extremely more volatile stage. There's no guarantee that rates are going to just continue to come down. It all depends on other economic indicators. Again, if the Fed pauses too much, you're going to see inflation come up, which is going to cause them to have to overlook that and say, well, the big fight is still against inflation. Therefore, we'll help these banks out, but we still have to fight inflation. I mean, it could really get interesting next week. So predictions-wise, short term, this is helping rates for sure. As long as nothing major happens or there's more blow-ups, we're going to see rates continuously, slowly go down from here. However, if the Fed comes out next Wednesday and says, we don't care about that much, it's not that big of a deal, our number one focus is inflation, that's all we care about, and that's all we're going to fight, and we're going to continue raising, you're going to see rates pop right back up. In the meantime, with all the chaos, trying to make sense of what's happening, why is it all happening? It's all because now we're starting to see major cracks in the economy, banking systems potentially broken, which the Fed is jumping in, the Treasury is jumping in and solving them. But the fact of the matter is things are starting to break, and because they're starting to break, the Fed now might shift their stance. Ultimately speaking, if they do shift their stance, we are going to see rates in the 5s by the end of this year, which, if you're a seller, obviously it's going to mean more buyers are going to jump in the market, and you're probably going to see home prices go up. unless there's something really crazy that's going to happen where housing is going to get impacted due to the fact that our economy is going to be in a severe recession. However, based on what the Fed's been doing, Treasury and everybody, that's most likely not going to happen where it's going to be severe. You're most likely going to see just more volatility as we progress. So there you have it. Very detailed because so much has happened over the last week. But overall, all of this has been rate friendly, not economy friendly. So there you have it. That is your weekly rate update. We'll keep you updated as things progress. And once the Fed does meet next week, we'll also update you that day and let you know exactly how the market's reacting to the Fed.